Hi, very good morning, everybody. Gary Crossley, Managing Director of Cullen Wealth. I've got Richard Cullen, Chairman, and I've got Stuart Arnold, the Director of Financial Planning, Head of Investment Committee.
Hi there.
Hi. And listen, we're going to have a chat this morning about some of the concerns and challenges we find in the current investment climate. And I, like many clients, would like to ask you two guys what Cullen Wealth are doing about the current investment proposition we have, and just have a bit of a natter and a chat about how things are looking.
I'll take that first, Gary, if that's all right. I think as head of the investment committee and a financial planner of 20 odd years now, this last couple of years has been some of the most challenging that we've seen. We've come out of the pandemic with no interest rates. The Bank of England base rate at 0.1%. Straight into a tidal wave of inflation. We've seen the highest inflation in over 40 years, and that's prompted some drastic action by the Bank of England to address that problem. And what the main thing that they've done there is that they've risen interest rates very severely and very quickly. We've gone from 0.1 to 5.25% base rate. Let's not underestimate just how significant that is. Huge change to our financial situation in the UK, and that's had some consequences. The consequences are, investments have reacted to that, and we've now had 23 months of investment downturn, if that's the right word to use. Doldrums is another word that I've used with some clients, and that would make this situation one of the longer periods of downturn than we've seen in the last 50 years. The average downturn is about 13 months as we get them, and so I'm not going to underestimate this situation, Gary. It's been a very severe, but I would also say it's a normalisation to bring things back to what we have seen over 50 plus years of time, with interest rates and inflation being at different levels than we've seen for some 15 years or so now.
Okay, so the next natural question would be, what are we doing about it? What's the investment committee's take on this, so that clients out there understand how we operate in the background that they might not see on a day-to-day basis?
Well, I mean, as you know, we have a forensic due diligence process that looks to put clients' investments, what I would describe as, in the right hands. That's not the best sales pitch I've ever given to anybody, but this is about putting the investments into companies that have big financial resources behind them. They have significant and good track records over many years. And one of the most important things for us is keeping costs for clients down. So, looking at the situation and finding those investments is important. And, what we also try to do, one of the most important things, is diversification, particularly when things are so uncertain. Being diverse is the most important thing, I think, and especially at the moment. So, we don't look for one style and one strategy. We look to mix things up a little bit, and we look to try and make sure that all our clients' investments are significantly globally diverse. And in the portfolios we recommend, unless you've got very specific preferences, our main recommendations to the large majority of our client population are very diverse investments.
And typically we use index tracking funds because they are hugely diversified, low cost. In our experience, and it's a well-known fact, that index funds tend to beat markets over time. 80% of index funds will beat the market that they are working in. And over time, funds that we've used have delivered really, really well, really strong returns. There are always going to be short-term blips and times when our style, and the style adopted by fund managers that we use, aren't the best, aren't the strongest in the market. But over time, what we are interested in is what happens long-term, what happens over 10, 15, 20 years, because that's what most of our clients are interested in, not what's happened over the last 2 years, disappointing as it can be to see a valuation where funds have gone down.
So all my pension funds, for example, are in our centralised investment proposition
Right, Tim.
at DT6. And so what would the common advice be for me when I'm not near retirement yet and potentially I could live another 30 years?
Well, forgive me for sharing any personal information, but I think you are 60 years of age, Gary.
61 next week.
61. Forgive me for sharing that, but you know, most people tend to live till their mid-80s. This is a lifelong strategy from our point of view. This is not a 1-year strategy or a 6-month strategy. We look to try and make sure that over the entire lifetime of your investment journey, you get the best possible outcome. So, you know, we're looking in, you know, if we take your situation, you know, for at least 25 years ahead, you know, and in that period of time, all manner of things are going to happen in the markets. You know, I think we can all say with our experience that investments wax and wane through different periods. You know, if you are expecting your investments to grow perpetually in value, then your expectations are wrong. You know, you have to take the rough and the smooth to a certain extent, but history and data tells us that over 5 years and longer, as Richard has pointed out there, investments usually deliver the best long-term outcome, because your main issue is inflation, right? You know, if you've got inflation at 2 or 3% per annum, if you're not keeping pace with that, then you are losing money. You might not see it, because you can see if you look, oh, I've got that amount of money. But if inflation's running at 3% per annum, you are losing, you know, and over 20 years, the real value of that investment, if it's not keeping pace with inflation, can be half.
What would you say, Stuart, to an investor that's thinking of pulling out and moving into cash? Given that the attractive interest rates now, 4-5%, banks, building societies, how would you advise a client that's wondering whether to pull out now?
No, I get it. You know, the temptation to do that is great at the moment, Richard. You know, we've got some of the more attractive cash rates than we've seen for over 15 years. And, you know, what cash would give to somebody is a bit more certainty, less variability in returns. But again, you've got to come back to that, you know, inflation question. At the moment, inflation, in fact, it fell to about 4.5% yesterday from about 6%. Forgive me, I can't quite remember the numbers. So we've had a good fall in inflation over the last month. Nevertheless, you know, with inflation at these levels and predicted to stay higher than normal for a while, the best guesses we've heard from some of our fund manager partners of late is that it will stay higher than the target 2%. You know, I've seen some numbers that would suggest next year it would be 3 or 4%. You know, if you aren't keeping pace with inflation, then you are still losing money effectively, even though you don't see that. Now you've got to bear in mind that if you get a 5% rate on cash at the moment, you aren't actually getting 5 because you've got to pay some tax on that interest largely. People get some tax allowances in there that will help. So you won't be getting that level of rate, and the rates are expected to fall. So you might get a very temporary relief, if you want to call it that, by moving to cash. I only see it being temporary. As we say, over 5 years and longer, we would expect, and history tells us, that the investment returns from stock markets and bond markets, for example, will be far more attractive. And most importantly, they should be able to keep pace with inflation and more after you take all the taxes and all the cost of your investments out. So I can get the temptation, but that would be a major reason why I wouldn't be moving to cash at the moment. I won't be keeping pace with inflation, I don't believe.
What about some of the clients are saying to us about the performance of Vanguard, Liontrust as parts of our investment proposition and the lower level risk at levels 3 and 4? Now we know financial planning is not about just performance and returns, it's about longevity, sustainability, and having a plan for people to meet their needs and objectives. But how would you counsel me? I'm higher than DT 3 and 4, but what's the current in-house view on that?
Well, I think Richard's pointed out, and it was Richard and I going back over 10 years now have put together what we believe is the most appropriate investment strategy for clients, which revolves around, as Richard said, low cost passive investment. And that means that, an investor's charges are low, and, over long periods of time, history tells us and data tells us that normally low cost investments, passive investments, do tend to be some of the most successful. Successful means, managing risk carefully, but also steady returns. It's about steady returns ultimately. So what's happened, it's since then, and what's been interesting to see over the last couple of years is that actually the actively managed investments, those that are different to the majority of what we do for clients, investments at a higher cost and usually over long periods of time don't deliver the same reliable returns, in my experience. But in the last couple of years, it's been those actively managed investments, Gary, that have been the stronger performers. And that's been the first time I've seen this as head of our investment committee in over a decade. For the majority of that time period, the passive low cost investments have delivered the stronger, more reliable returns. But the last couple of years, we have seen stronger returns from actives.
There's definitely going to be periods when active fund managers get it right and they make good calls, good investments, and their portfolios and their funds do particularly well. And this is one of those periods where that's been the case. It's a very, very difficult thing to do, to pick active fund managers that are going to outperform markets over the long term. To pick those funds in advance is an incredibly challenging thing to do, which is why we prefer to, in casino terms, bet on the house, don't bet on the tables.
Okay, so we know that Consumer Duty is being brought in by the regulatory body, the FCA, and which is about fair value for clients, demonstrating that we're enriching their journey with us. So clients will often say, well, my portfolio's gone down. Why am I paying you the fees I'm paying you? And, I'm in that situation. So what would you say to a client that asks a question about the fees that they're paying?
The answer to that is that performance is just one aspect of many things we do for clients, Gary. What you've got to think about in your financial planning, we've got to be looking at not just getting you the best return that we can possibly achieve for you. It's about, making good decisions with your money. How much money to spend every year, how much to invest to get to the outcome that you want to get get that, that financial experience you need into, later in your life to feel comfortable financially, peace of mind. We look at tax, that's a big part of it. And, what we try and make sure is that, clients pay the least amount of tax they possibly can within all the allowances that they've got. So it's about a series of things. Many clients benefit from our cash flow modelling tool. And that, to me, that brings a financial plan to life. And it's also about governing all of this. And in the investment committee, what we do is that we scrutinise the whole market pretty much every day of the week, don't we? Our team is looking all the time at the best outcomes for clients, the best providers to work with, the best fund managers, the most financially secure, the most price competitive. There's a whole myriad of things that many clients don't actually see behind the scenes that we do.
So in terms of a client then that's slightly nervous, what would your message be, Richard?
I would say, first of all, and hopefully this has been coming through from everything we've seen, we're interested in the long term. Most of our clients, I'm nervous. I look at my funds and they've gone down.
So do I.
It's a natural human instinct to look and think, well, I've lost money or I haven't made money. But I'm not interested. And I think most of our clients are looking to plan for the long term. So where we are right now is just a point in time. And most of our clients aren't looking to access their money right now. They may be interested in some of it, but they're interested in making plans for the future. And the future normally means long term. So this is a point in time within a long period of time for most clients investing. So natural nervousness, yes, hang on, stick to the principles that we're talking about, long-term investing. And long-term, we're really confident that our policy and markets will deliver the returns that clients need to enjoy their long-term aspirations, be it retirement or whatever it is.
We also know, don't we, that investments, vary in value. You are never going to have an investment in the markets that constantly makes money. That's just not possible. And so from that point of view, you've got to take the rough and the smooth. And this is not the time to be selling your investments. If you've seen your house value fall, you don't go, oh God, the house has fallen in value, I'm going to sell it. You don't say that, do you? It's not the right time to be doing those things. You only crystallize those paper losses if you choose to sell your investments at this point. What we do know as well is that the investments have the capability to recover their recent losses and deliver great long-term returns.
And we don't know when that will be.
No,
we don't know when the upturn will be, but an investor that pulls out now will miss the upturn. It's a very, very difficult thing to guess when to go back into the market and take the upturn.
I think it was often said, wasn't it, that in 2 of 5 years, or in 2 of, you would lose money, you'd be guaranteed to lose money on your portfolio in 2 out of 5 years, but over a 5-year period and longer, you would be better off than your starting point, which seems to have been borne out for many, many years. So
I'm nervous about your word guarantee there. What I wanted to say, in response to that is nothing is guaranteed here. The investments will behave in line with the financial markets around the globe. Trends and history tells us that, you do get, a bad year here and there. And usually that comes, once or twice in 5 or 6 years. But anything could happen going forwards.
I'm happy to be corrected, Stuart. Thank you. Yeah. Well, listen, I think that's just been a useful little update.
I suppose one final matter, Stu, can we just talk a bit about Liontrust and where that sits in our portfolios? And we know that their style has been one that's been particularly challenged in recent years, and clients have been in for 2.5 years or so since we introduced it to the investment committee. And what would you say to a client that's gone with Liontrust, likes the idea of socially invested money, doing good things for the world? What would you say to somebody now that's thinking, well, did I make a good decision? Do we have conviction and belief in Liontrust long term, and how are we scrutinising Liontrust as a long term partner?
Yeah. Thanks, Richard. I think I wanted to go back to the very start of why we introduced Liontrust. We've seen environmental and social governance becoming a more prominent thing, in many areas of our lives. I think we all, and in the main, most of the people I talk to are keen to be doing things that are friendly and supportive to humankind and the environment.
People care about these.
They do. And, we can see that from the questions we get from clients, the requests we get from clients. We can see the government net zero targets, etc. So, this is only going in one direction, really, and that's forwards and more advanced. So, we felt it really important to introduce some element of sustainability and friendliness into our portfolios for numerous reasons. So, we go through the same forensic process, really, in determining, the funds that we recommend to clients. Our investment committee has got some incredible technical expertise behind it. Between us and those, there's about 200 years of experience, for example. So we don't arrive at Liontrust lightly without that really detailed due diligence process. And we arrived at Liontrust because, firstly, it was the best fit for what we believe is right for our clients long term. It's a multi-asset fund. That means that it invests all around the globe. it can vary where it invests and move the investments around, which we know our colleagues at Liontrust are doing. But also it manages risk. So the other part of this for our clients out there who want their investments to be risk managed, Liontrust is part of that process, and it aligns to what we believe is right. Other things to bear in mind there is the Liontrust Fund has been around for 22 years now. The sustainable range is not new. It has an exceptional track record. The size of the funds, if you look at how much money the Liontrust managers are entrusted to invest for their investors, it's into the billions. It is a huge and very well respected fund for many, many years. Now, they also admit that there are certain market conditions out there and around the world that affect the fund adversely. And it just so happens that pretty soon after we introduced it to our clients, some of those market conditions that do affect that fund adversely have occurred. You know, the ESG sector, if you look at the ESG sector, has been a smorgasbord of funds that deliver very different outcomes in very specific market conditions. So to be an ESG fund, firstly and foremostly, you can only invest into stocks, companies and governments, etc., that are deemed to be friendly to humankind and the environment. So quite normally that means that, you know, the selection of investments that exists for investors out there is very narrow. It's far narrower than the main investments, the non-ESG investments in our main portfolios. So they're going to behave more erratically. It just so happens that the Liontrust style is such that, you know, some of the key events over the last couple of years have adversely affected that fund a lot more extremely than other funds that do things very differently. So as a consequence of those factors, the last couple of years with Liontrust have been a very difficult one, to be fair. Nevertheless, you know, what we've got to remember here and think about is that this fund has delivered fantastic investment returns and risk management to clients for 22 years. And there have been 4 occasions in those 22 years where the market conditions have been such that adversely affect that fund. We just so happen to be in one of those now. So I would like to say to you guys and to our clients that we have complete conviction and confidence that Liontrust is a very, very safe investment for clients. And over the long term, we'll come back to this long-term point, over the long term, their clients are probably, again, can't guarantee anything, Gary, are probably going to see exceptional returns from that fund.
At some point, the market conditions will be right to see a significant bounce for their style.
Yeah. And what we've seen, particularly in the last 2 years, is that the ESG sector as a whole, from an investment point of view, has been even more volatile than the normal non-ESG investments. So we're in a bit of a storm with it. I'm not going to lie, you know. But our due diligence process. So, for example, just give you an example there. You know, we actually managed to get an hour with the chief executive of Liontrust, a chap called John Irons, as part of our kind of due diligence process and governance process for clients. We got an hour with John back in the summer, where we asked him some searching questions on behalf of clients about what's going on, what are Liontrust doing about this situation. And to be fair to John, firstly, he gave us an hour of his time, which was incredible to get that for us and our clients. But secondly, he said, we have our core principles at Liontrust, like we do at Cullen Wealth. We have our core principles, and we're not changing. We're not panicking about this, and we're not going to change what has been a successful investment strategy over a 22-year period because of a series of events in a short period of time that has adversely affected our funds. And frankly, I really respect and agree with that, as do how I think about the Cullen Wealth philosophy. We can see over the last 2 years that different styles and funds have been stronger performers. But we aren't about to change what has worked for 10+ years for clients on the back of some of the most extreme investment conditions in many years.
Thank you.
Absolutely right.
Yeah, well, listen, I hope that's been useful to colleagues and to clients. Please give us feedback. Please engage with the consultants. We're all available to take questions and assist you as far as we possibly can. Thank you, Stuart. Thank you, Richard. And have a great day.
Thank you very much. Bye.